Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, after 10 increases, the Federal Reserve takes a pause. But are we done raising rates? The head of the Fed, Chairman Jay Powell, said there may be more rate increases to come, depending on future spending. So don't be complacent, be prepared. And this week, the government released inflation numbers for May. So is the raising of rates working in lowering inflation? We're going to find out tonight from the Chief Investment Officer of Citi's Global Wealth, David Balin. David has $53 billion in assets under management, and we'll find out how we should be investing for the rest of 2023. We'll ask David. I'm Andre Laborde. We've got these stories and more. So sit back, relax. Let's have 30 minutes together. It's Friday, and it's time for Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. I'm Andre Laborde. It's Friday, June the 16th. Well, the Federal Reserve met this week, as they were expected, but for the first time in over a year, instead of raising interest rates, they paused so the economy could take a breath. So for 10 straight Fed meetings, Chairman Jay Powell and the other Fed governors have raised interest rates to curb inflation. This week, they finally paused, and Jay Powell was insistent, though, that this is only a pause and don't read into it that there won't be any more rate increases to come. So with a pause in rate increases, how did our money do this week? Well, the Dow Jones, they ended negative for the day, but positive for the week. And it was brought down by United Health, a Dow component, because now those putting off elective surgeries are returning, so all the healthcare companies were down. Top sectors for the day were utilities and energy. And sector laggards for the day were communication services and technology. And the S&P 500 posted their fifth straight positive week. This week, the Dow Jones closed today at 34,288. It was up just almost 1.25% for the week. The S&P 500, they closed today at 4409, which was just up over 2.5% for the week. And the NASDAQ, they closed today at 13,689, up just over 3.5% for the week. Now, where do we go from here? Well, according to stock historian Ryan Dietrich from the Carson Group, he's done research on this very topic, and he found that when the S&P makes a new 52-week high, which it has, and has more than a year without making one, which it has done, the index has gone up 100% of the time. Now, not 80 or 90% of the time, but 100% of the time. Now, this has happened 15 times in the last 7 years, and the median gain has been 14%. Now, also, in the last 5 of those times, in 1995, 1988, 1982, 1958, and in 1954, according to Ryan Dietrich, the S&P has risen 20%. Now, not always remember the disclaimer of past performance does not guarantee future performance. But if you're in the belief of a bull market is coming and your past performance is 15 out of 15, those are good odds. The Bureau of Labor Statistics released inflation numbers this week, and last month we rose 0.1% for the month and 4% for the year. And 4% inflation rate year over year is the lowest since March of 2021. Retails are up 0.3%. Energy prices since last year has actually gone down 11%. And if you want a job, you probably can get one. Well, still not the 2% goal of the Federal Reserve, but the trend is our friend. Prices going up included car repairs and pet food, and prices, though, going down were airfare for the summer and gas. 4 times a year, there's what's called the triple witching day. It comes 4 times. Now, options held by stock traders are expiring. It's not as dominant as it used to be because weekly and now monthly options have become so big in the derivative market. But in the S&P 500, at that time is rebalanced. Some stocks in the S&P are taken out and an equal portion are put in. Come this Tuesday, Palo Alto Networks are going to be added, included in the S&P 500, and Dish Networks will be taken out. Now, why is this important? because mutual funds and fund managers who buy the S&P 500 will be selling their Dish and buying Palo Alto. Companies announcing buybacks this week include Apple, Alphabet or Google, oil companies including ExxonMobil and Chevron, and also Meta or Facebook. That's some food for thought. Now, are we in a recession or maybe going into one? What stocks should we be buying and going into the second half of 2023? And should we be looking at maybe international stocks as well? David Balin, he's the Chief Investment Officer at Citi Global Wealth with $53 billion of assets under management. And we're going to ask him these questions and more. Hi, David. Welcome to Wall Street Wrap-Up.
Thank you so much for having me. I'm excited to be here.
David, last week, the S&P 500 had just gotten out of a bear market when we crossed 4305, and it was the longest since like 1948. Do you think that we'll be seeing those lows again?
I don't think we will. If you take a look at 2022, we saw that the stock and bond market were down by the most in a very long time. Only in 1931 and in 1969 did we see both the stock and bond market go down significantly, and the average portfolio was down about 16.5% in 2022. So that was pretty bad performance. This year, I think the market surprised everybody. It's up, depending upon what your portfolio you have, anywhere between 6 and 11%. And everyone was, of course, expecting a recession in the markets to go down further. So while I'm not entirely sure that we're in a real bull market at this point, I certainly feel confident that there are aspects of the economy that are healing well, and that I think will carry us into a positive territory over the next year and a half.
Well, this week, the Consumer Price Index for May was released, and year over year, we were up 4%, which the market this week seemed to like that. Do you think that this would help propel that what you're talking about, that we're going to be seeing more bulls than possibly bears?
So you're absolutely right. Let's take a look at where we were. At its peak in the U.S., inflation was at about 9%. And there was inflation across the entire economy, meaning in manufacturing, in parts and supplies, in transportation, in rent, everywhere. And when you take a look at the leading indicators and the lagging indicators, right, those are how we sort of look at the world. And the leading indicators have come down an enormous amount already, right, whether it's food or even energy. But when we take a look at the lagging indicators, which is what the Fed is looking at, we can see that there are a few of them, like housing, that are still elevated, but many of them have come down. All of this suggests that the Fed is probably at or near the end of its tightening cycle, and that's what the market needs to see in order to continue to move higher. It ultimately needs to see rates go down, but I think for the moment, this week especially, seeing inflation stay consistent means that it's unlikely rates are going to go that much higher.
Well, I've followed your thoughts in the past, and I know at one time you were thinking that in the fourth quarter that the Federal Reserve would even lower interest rates. With the CPI numbers that came out this week, do you still think that possibly in the fourth quarter that they may not go up, but they may go actually down in the fourth quarter?
It's hard to tell. I mean, my current view is that the Fed is very much looking at inflation data, and it's looking at the hardest set of data. In other words, the one that's most likely to stay higher for longer. And that means that the Fed is more likely to keep rates higher for longer, and that is my current view. What I do think is going to occur is once we see unemployment actually rise, not just data indicating that it might, the Fed will eventually pivot. And when it does pivot, it's going to pivot fairly hard in order to protect whatever the recovery that's coming will be in 24. But I do think that could occur at the end of this year. It could occur at the beginning of next year, but it will definitely occur because we think that unemployment will rise due to the Fed's really strident moves of interest rates up.
So you're thinking the key metric to be looking for is the unemployment rate. So since we've already had last month's unemployment rate that came out, we'll be having a better idea for July. So how the unemployment rate came out for June?
That's right. And I don't expect that unemployment is going to really start to rise appreciably for several months. But when it does finally rise, I think it will do so fairly significantly. We estimate that there could be between 1.5 million and 2 million total job losses, in the U.S. economy as a result of these rate hikes. And I don't think anyone is really expecting that that's actually going to fully take place. But that is what we anticipate. And one of the reasons why we think that's the case is that in order to bring inflation down to 2%, the Fed is going to need to see a real cooling in wages, and that will require significant unemployment.
From what I understand from the Treasury Department, now we've already finished the debt ceiling crisis a week or so ago, where we raised the debt ceiling. But the Treasury Department, I saw this week, said that they're going to be selling Treasury bonds of about $1.3 trillion between now to the end of the year. Well, if they're selling this many treasuries, which is taking $1.3 trillion out of the economy to buy bonds, without having this kind of currency in the market, will that stop or hinder business? And also, will that stop and hinder the purchase of equities, which will then go along with what you're saying, or possibly unemployment?
$1.3 trillion is, as you know, a lot of money.
Mm-hmm.
And it's about $400 to $500 billion more than would be normal, because the Treasury depleted its coffers in the 4 months prior to the debt ceiling negotiations. So what really we have to watch is where the money is going to come from. If the money that goes into bonds comes out of, Treasury bills, right, or comes out of, let's just say, money markets, which is really what I think the most likely scenario is, that will have very little impact on anything. If the money were to come out of deposits at banks, that would have a deleterious effect on the economy, because it would restrict lending. So we have to see where it comes from. And I think that will determine a lot about the direction of the market. In the event that it's fairly innocuous, I think that would be a good sign for the market, to be able to continue going higher.
Well, now that's a good point, Dave, because I remember seeing one of the data points was that they reported that there's about $5.2 or $5.3 trillion in money markets. So if that 1.3 comes out of that area, then it really will not have the effect of hurting businesses, small businesses, I guess, right?
That's right. And I think that, where we are vulnerable, and I think you've touched upon this, is that, our small and medium-sized banks right now are vulnerable, depending upon, their deposits and their loans and the ratio of the two. And if we were to see, deposits shrink appreciably at our small and medium-sized banks, that would definitely constrain loans, future loans, to all of the small and medium-sized businesses, which are essential to the U.S. economy.
Have you noticed an influx of more either deposits at Citi, because you're one of the major banks, but you and BOA and also maybe Chase, and have you been able to see more influx of investors in the Citi Global Wealth Fund?
And when we take a look at what actually happened, there were a couple of weeks when all of the major banks actually saw net new deposits, but that actually pretty much tailed off quickly once the government, stepped in and made sure that the banks, Signature and First Republic and SVB were dealt with. So I don't think there was a huge, a flight to quality at this point, or flight to largeness, at this point. But that is something that is a risk. In terms of money flowing in, what's been really interesting, of course, is the amount of cash that our investors are holding, which I actually think is way too much cash at this point, because with rates where they are right now, and with the prospect that they're going to go down over the course of the next year or two, we really want our clients to be moving from cash into intermediate duration fixed income portfolios, and even more preferably into core portfolios. We don't want them to be fixated, with their deposits and with their T-bills.
For your clients at the Citi Global Wealth, are you more steering them towards fixed income, like as in corporate bonds or other types of bonds, as compared to, say, equities?
Yeah, so I mean, if I had, was advising, my parents or a typical client, I really want them to have a balanced, portfolio, risk weighted to whatever their correct amount of equities and debt are. But the reason I mention that is that market timing has been really bad for clients this year. Those clients that went into cash during 2022 and did not go back into fully invested portfolios have missed a rally, as I mentioned earlier, of anywhere from 6 to 11% in the typical portfolio that's here. And that's way better than they would have done in cash. So what we want our clients to do is to stay fully invested right during the whole period of time, so that they don't market time and miss those up days. And secondly, they should allow us to expose them to the parts of the market that are most likely to be advantageous for them over the coming year or two. And that's something that's very hard for a client to do on their own, right? When do they enter emerging market stocks? When do they enter growth stocks, things like that? And I think that that's something that is really important to clients, is to actually rotate what equities you're in, not just be in equities.
Like many economists are predicting that a possible recession may be coming toward the end of this year or possibly to next year. And David, I ask that question because of what let's say if you're advising clients, how would you position your portfolio that whatever that answer you might be is, yes, we are going to be having a recession, or no, we're not, but where's the best investment locations?
So, I kind of want to tell people right now that this is already, part of our economy is already in a rolling recession, right? Take a look at certain areas of the economy, whether it's, manufacturing, consumer goods, certain parts of our transportation sector are in recessionary conditions right now. Other parts and services like travel and leisure are actually in a growth mode. Certain technology companies are growing, certain small and medium-sized companies are not. So this is an economy that's in flux and really not on an even keel. So when we talk about a recession, in our mind, we're talking about a rolling recession. And in that situation, right, you can't really time markets as to whether you want to be invested in equities or bonds. You need to be fully invested, but you can time where you want to actually enter different markets. And I'll give you an example of that. So in the first year of a full economic recovery, you want to be in small and medium-sized stocks. They typically do well for that first year. They're typically going to see a resurgence of demand because their inventories have been depleted. And that is something that's ahead of us. So we are actually in the process of moving our portfolios into small and medium-sized parts of the market, companies across the S&P and across NASDAQ.
If with a possible rolling recession like what we're having at this moment, and with the markets going up as it is, do you see that there's a lot of investors are maybe having a FOMO, which is a fear of missing out? So they're purchasing stocks right now because they're seeing the stock market, S&P and NASDAQ and Dow, heading in an upward trajectory?
To some degree, I'm absolutely sure that's due. Let's spend a second just talking about what's happened in the market, right? If you take a look at the market today, about 10 stocks represent more than 85% of the market increases, right? The large cap stocks, large cap growth has really driven the market higher so far. So the good news, if you own an indice, you actually get exposure to that. If you didn't own those stocks or didn't own an index, you didn't get exposure to that, which means that 90+% of the stocks have not done unusually well at this point in time. And when we have a full recovery, the entire market is going to move up, right? And so we're going to see that as the next leg, if you will, after the initial move up, once we get into a post-recessionary environment. Second thing I think people have to look at is the relative value, right, of the U.S. market versus international stocks. Right now is the third, the international stocks are at their third largest discount, right, in history since 1935. So we want our clients to begin moving, money into foreign markets. That's another good area of value, and we want them to do so, again, ahead of that market, moving ahead. And we think that there's a lot of opportunities like that, across the world, and that's what we're focusing on now. Where should our clients move money to in equities? Not whether or not they should be in equities, which they should be.
Well, I know that in the Japanese stock market has been soaring because of the yen and also with the U.S. dollar the way it is right now. If somebody wants to get into the foreign markets, let's say, and I'm thinking of Japan or Europe as well too, is it too late, or you think there's still time to jump on the bandwagon?
So let's just talk about this concept of too late. Everybody would like to find the perfect time to enter the markets, and there is no perfect time. So I just want to say that they've missed. An investor who's looking out over the next 5 years has missed nothing so far, nothing. And here's why I say that. We just increased our strategic return estimates at Citi Global Wealth from 22 to 23. Why did we increase them? Number one, we have a bear market, part of a bear market behind us. Number two, the economic growth that's to come is greater than what we've experienced over the last year and a half. Number three, foreign markets have not revalued at all. And some of the markets that are either damaged or most likely to be damaged in real estate, for example, those will represent good investment opportunities in the future as well. So clients have not missed much of anything yet. That's why we want them to get invested for the next period of time, the next growth period, which is ahead of us. So that attitude, I think, will give a retail investor or a professional investor hope that they haven't missed things, and that if they do get invested tomorrow, they're going to have a reasonably good return over the course of the next year or two or beyond.
You were mentioning how there's really a few stocks, and I'm thinking right now of the S&P 500. There's like 7 stocks that are the engines of the other 493, and I'm thinking they're mostly tech. You're looking at Meta, you're looking at Amazon, Apple, Microsoft, NVIDIA, things like that. Mostly tech. With interest rates, if the rates go down, like what we were talking about before, I'm assuming that'll help tech. But first off, will it? And if the rates stay the way it is, will technology still be strong, you think, in the second half of this year?
So, the most important thing, observation that you've made is this sort of lack of broad leadership in the market. So one of the reasons why markets have, consolidated is because once rates went up and capital became scarce, all of the unprofitable companies, whether it's in biotechnology or, cybersecurity or SaaS, all of those companies really, got revalued significantly downward. The average unprofitable stock from peak to trough is down more than 75%. So the world bifurcated into profitable and unprofitable companies. Why did it do that? Because profitable companies can fund themselves and unprofitable ones can't. So when rates come down, that will be an indication that capital markets will become more open. IPOs will begin to will begin to be issued again. And that will be an indication, I think, that the market in general will be more highly valued across a broader spectrum of stocks. So that's, as I mentioned earlier, the second leg of what we could see as a major recovery in markets at the end of 23 or 24.
Do you see any black swans coming up, whether it be at the end of this year or next year? And here's what I'm thinking of. Let's say situations with China. We still have many companies, Nike, Apple, and others, that are doing business with China. If China moves in, there's a threat of possibly going into Taiwan.
Any war, in Taiwan or war with China, I think would be, an even greater calamity than what we're experiencing now in the Ukraine. And so I think that would be the kind of black swan event that no one's really priced into the market at all at this point. Mm-hmm. So let's put that on the table. Second type of black swan really is some type of credit crisis that we can't anticipate. We saw 3 major bank failures in the United States. We saw 1 in Europe. If we were to see another regional bank or 2 fail, that could be a sign that we have, real credit issues in the economy in the United States, and that would potentially be a black swan type of event, unanticipated and very large. But what I would say is that, it's the cascade of events at the end of the day that determines really the direction of the economy. And unlike 08 and 09 or 2020, we don't see the sort of downward V-shaped, recession that everyone, I guess, is anticipating. It's going to be, relatively shallow, in terms of what it looks like. So it's going to take a considerable amount of unexpected bad news to give us a real, down cycle from where we are today.
David, I was reading this month's issue of Bloomberg, and you were being interviewed about your thoughts on artificial intelligence. For investors out there that would like to get involved into the investment of AI, how could they go about doing that?
Well, that's a great question, and everyone's interested in it. Let's talk about what AI is, right? It's this technology that is truly revolutionary, more important than the internet itself. It allows us to query an extraordinary amount of information at once and get, written text back that makes sense. It allows us to do the same thing with numbers. So when we think about the impact of AI in industry, it will be the companies that use it in their daily business that will be the big beneficiaries. And so what we want our clients to do is to get exposure to the companies that will use AI. Right now, what's going up in the market are chips, storage, for cloud storage. But ultimately, it's the increase in profitability, the increase in efficiency that AI will drive that will ultimately have the biggest impact on portfolios. So whether it's a company that does consulting, it does SaaS, it does coding, it basically provides customer service that can be automated. Any of those things will become radically changed in terms of how they're ultimately delivered, and that is where we're going to steer our clients. It's going to take, a full 5 years for AI technology to affect every stock, but it will. And so, as I like to say, AI will actually tell us which companies are using AI, and that's how we're going to actually use it in terms of building our portfolios.
Good point. David, with all the clients that you've talked to and as long as you've been in the business, what would you say is the most common mistake or mistakes that investors make?
Fear is the greatest thing that keeps people from investing well, right? They're either, fearful that things are going to get worse, markets are going to go down, that they somehow have a crystal ball which allows them to see when to invest and when not to invest. And, it reminds me of the Warren Buffett quote, right, which is when things are worst, you actually, want to be greedy. Mm-hmm. But the truth is that the best investment advice is to actually have a core portfolio of stocks and bonds that meets your risk profile. Always keep it invested, to rotate what kind of bonds and what type of stocks that you have, and to do that consistently over, decades. That is how to build real wealth. Getting in and out of the markets is a fool's game. And so that to me is the most important way to invest, and not doing that, right, to your point, if people don't do that, they actually ultimately really crush their long-term returns.
What a great way to end it. David, I thoroughly enjoyed it. I hope you come back.
I do, and I thank you so much for the invitation. I hope I come back as well. Thank you so much.
Thank you, David. Well, if you have a question or maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us. And notice the new email address at andre@benacapital.com. So let's take a look at the markets heading into next week. But first, what Detroit car company was launched on this day in a refurbished wagon factory? We've got the answer, and it's coming up. Well, what Detroit car company was launched on this day in a refurbished wagon factory? Ford Motor Company in 1903. See, Henry Ford raised $28,000 from 12 investors, including a coal dealer, a carpenter, and a man who made windmills. Well, let's have wrap up on Wall Street. Did you ever get frustrated when you give a credit card for a cup of coffee, or maybe you're at the grocery store and they ask you for how much tip you'd like to leave? Or even worse, when a suggested tip is already on the machine? Well, it seems like most Americans are getting fed up with this process as well. So according to Bankrate.com, 66% of adults have a negative view of tipping, and 32% of Americans are now annoyed with that pre-entered tip screen. Well, good news for UPS drivers these hot summer days. Unions' demands have been met so that UPS drivers are going to be getting air conditioning in their trucks. And that's a wrap-up on Wall Street Wrap-Up. Join me next week when, now with the summer vacation season has begun, how will oil prices affect the price of gas at the pump? When my guest will be Francisco Blanch. Francisco is head of global commodities at Bank of America, and he'll be with us next week. And that's our show for this Friday, June 16th. I want to thank David Balin for being with us this evening, but as always, we appreciate you for allowing us into your homes tonight. Have a fun weekend with the ones you love, and a happy Father's Day this Sunday. And the markets are going to be closed on Monday for Juneteenth. I'll see you next week. And remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.